Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now I run a penny stock service for Equitymaster known as Exponential Profits. And I'm going through a dream run there. I have closed 25 positions in the service since July 2020 and not a single one at a loss. Yes, that's right. 25 consecutive recommendations, all closed at a profit. The average gain per stock is around 72% and the average holding period is 10 months, that is less than a year. Now if things go as per plan, I think I can close another 5-6 penny stocks, again all in profit. So that will make a winning streak of around 30 recommendations. Of course, the bull market of the last 20 months or so has certainly helped, but it's still a noteworthy achievement in my view. To be honest, I have a bigger motive than blowing my own trumpet here. I want to talk about how I managed to achieve this track record and how even you can do the same provided you are disciplined and follow a sound process. You see, before I hit my current winning streak, I had to suffer a 6-stock losing streak. We launched the service back in October 2018, and between October 2018 and January 2020, we closed a total of 6 recommendations, all at a loss. And the losses were no ordinary ones, the smallest one being 42% and the biggest one being a huge 91%. Well, there's only one word for this. Ouch. Now, the reason my subscribers didn't haul me over the coals or throw me to the wolves was because a large percentage of the penny stock corpus was in fixed deposits. I had recommended my subscribers back then to be as much as 70 to 75% in fixed deposits and only 25% in stocks. Therefore, even though I was not able to close a single recommendation in profit and had incurred 6 consecutive losses, the loss at the level of the overall corpus wasn't more than 20 to 25%. Because we had only 25% exposure to penny stocks in the penny stock portfolio, the overall damage was quite small. And herein lies one of the most important rules of investing in penny stocks. You see, the right time to invest in penny stocks is not when the markets have gone up a great deal from their lows, but after they have fallen a lot from the top. When we launched the service in October 2018, the market was already up around 50% from its bear market lows of February 2016. So this was not a market that was down from its highs, but was up 50% from its lows. Secondly, the market was not cheap from a valuation standpoint either. The Sensex PE back in October 2018 when we launched the service was around 22-23 times its trailing 12-month earnings. Now this was higher than its long-term average of around 20 to 21 times. Therefore, both from a valuation standpoint as well as rise from the bottom standpoint, the environment wasn't conducive for taking a significant exposure to penny stocks. You see, penny stocks both rise disproportionately during a bull market and also fall the same way in a bear market. This means that they go up much faster as compared to the broader market during a bull market and also fall a lot more than the broader market during a bear market. Now, the big mistake that most investors make is that they get interested in penny stocks only after the broader market has gone up a great deal and give up on them after the market has fallen. This behavior is completely opposite to what they should be doing, and this is why they end up having such a bad result from penny stocks. So this is something I pay a lot of attention to when recommending penny stocks to my subscribers. Here's a simple rule I follow. Every few months I take a look at the broader stock market and then decide on my allocation to penny stocks. If the markets are up 50%, 60% from their lows, and the Sensex PE is more than its historical average of around 21 times, I allocate only 50% to penny stocks and sometimes even less, and the remaining I ask my subscribers to be in fixed deposits. And then when the market falls meaningfully, say 20% or more, I start increasing allocation to stocks and recommend a bunch of penny stocks. I will repeat that again. When the markets turn expensive, I reduce my allocation to penny stocks, and when they turn cheap, I increase my allocation. Now, what this rule does is that it automatically allows to buy more penny stocks when the markets are cheap and reduce exposure when they turn expensive. As I said earlier, this is opposite to what most people end up doing while investing in penny stocks. They go by their emotions and don't consider the broader market valuations at all. They end up taking more exposure to penny stocks when they feel most comfortable and reduce exposure when they feel nauseous or highly uncomfortable. But as I said earlier, we don't go by emotions but take a call based entirely on numbers and facts. According to us, the right time to invest in penny stocks is when most people are feeling uncomfortable in doing so, and a bad time to invest is when they are feeling comfortable. Our rule ensures that we end up doing this exactly over and over again. Now, the reason my subscribers have earned a lot of money from penny stocks over the last 18 months or so is because I recommended a lot of stocks right after the market crashed back in March 2020. You see, after the crash, the markets had turned a lot more attractive, and therefore I went on a penny stock recommendation spree and ended up closing my last 25 recommendations at a significant profit. Besides, I also had the money to be deployed into penny stocks as I was sitting on FDs to the tune of almost 70 to 75% of the portfolio. A lot of people also face this problem. They end up being fully invested at the top of a bull market and therefore have no money left after the market crashes and stocks become more attractive. So please note that the right time to take a large exposure to penny stocks is not right now, but it was back in March 2020. Now, of course, this does not mean that one should be completely out of penny stocks right now. No, I would never recommend that. In my view, if you have a penny stock portfolio, then you should have at least 25% exposure to penny stocks at all times, and this allocation should not go below 25% at any cost. Likewise, the maximum exposure you should take is 75% and not more. You see, I view investing as a game of probabilities and not certainties, and therefore I am never 100% in or 100% out of penny stocks at any given point in time. Now, coming to the current scenario, I think it will be a good idea to be only 50% invested in penny stocks and keep the remaining 50% in fixed deposits, or perhaps one could consider being only 25% in penny stocks and keep the remaining 75% in fixed deposits. I don't think this is the kind of market where you can be maximum 75% in penny stocks. This was a very good allocation back in March 2020 after the markets were down almost 40% from the top, but not right now, when the markets have more than doubled since then. So a good allocation for penny stocks right now is say anything between 25% to 50% of your total penny stock portfolio. Now to the more important point. What are the kind of penny stocks one should invest in for the next 12 to 15 months? You would say, yes, Rahul, your point about being only 50% or less invested in penny stocks is well taken. But what are the kind of penny stocks should one buy? Well, here again, I am slightly different from the rest of the crowd. When investing in penny stocks, I am not looking at the next big winner. I am not looking for a penny stock which is likely to be a 5-bagger or a 10-bagger over the next 1 to 2 years. I think penny stocks of this kind are fraught with risks. I am happy looking for penny stocks that will end up giving me 50% to 100% returns over the next 1 to 2 years. This is a good enough return if you ask me. However, what's more important to me is that I have some kind of a downside protection. Now let me be clear here. I don't like to lose money, and therefore I am willing to take every action possible that will protect me from a significant downside. Which is why frequently loss-making or highly leveraged penny stocks are a strict no-no for me, no matter how attractive the growth prospects. Say something like a Vodafone Idea or Suzlon Energy. Although these penny stocks have done well over the last 1 year or so, I won't touch them with a 10-foot pole because they are not out of the woods yet. They are still loss-making and have balance sheets that are loaded with debt. So my goal is simple. I look to buy a 100 rupee note for rupees 80 or lower. If you are buying a fundamentally strong penny stock and if you are not paying too much for it, that is, you are ensuring a big fat margin of safety, then you would have taken a big step towards putting together a strong penny stock portfolio. Take a look at this list of stocks, for example. The common thread amongst these 16 penny stocks is that they all have a current dividend yield of at least 2.5% or more. Besides, their debt to equity ratio is also less than 1. But why a dividend yield of 2.5% or more? Well, this is because that's almost half the rate that you're getting on your bank fixed deposits, and therefore there is a decent margin of safety here. Assuming that all of these stocks maintain their dividend payouts, which I think they should, you are getting almost half the FD rate as dividends, plus a capital appreciation which can come over the next 1 to 2 years. Now, I am not saying that these stocks will not correct if there is a correction in the stock market. However, I would like to believe that these stocks may correct a lot less than the other penny stocks that pay no dividends or where the business models are dicey. Therefore, there is a downside protection here, plus there could also be a decent upside if the bull market continues. As to how long one should hold on to these stocks if one decides to buy them, well, I would say a maximum holding period of no more than 2 years. Once the 2-year period ends, one should move out, no questions asked. Please note that this is not a recommendation from our side. You are advised to do your own research or consult your investment advisor. By the way, my definition of a penny stock is the one where the price is in double digits at the time of buying. So any stock with a price of rupees 99.99 or lower qualifies as a penny stock for me. It should be noted that all the stocks on this list currently trade in double digits. So this was the list of my preferred penny stocks for 2022 and the logic behind the same. I also spoke about how this may not be the best time to have the highest possible allocation to penny stocks and how your exposure should be lower than the maximum allowable limit of 75%. Do let me know what you think of the list and whether you agree with my assessment. With this, I will take your leave today and see you again soon. By the way, do not forget to send in your comments and likes and dislikes. They are very important to us. Goodbye and take care.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.